Hello, I'm Adrian Cronje, the CEO and CIO of Ballantine. It has been a tumultuous year. We've had to navigate a global pandemic, a severe recession, which some have characterized as a mini depression, social unrest, and now, of course, another epic week in which we dealt with a particularly divided election. It is noon on Thursday, the 5th of November, and we still don't yet know the result, although it seems clear that the most likely outcome is that Joe Biden will become the next president of the United States, that the Senate will remain in Republican control, and that the House of Representatives will continue to be controlled by the Democratic Party. So essentially, a gridlocked result. We will be dealing with the exact implications of the final result in due course, when we will be providing a deeper dive on the implications for investment strategy and financial planning. But I've asked our Director of Research, Gabe Lembeck, on our investment strategy team, and John Madison, a partner of our firm in the Raleigh, North Carolina office, who heads our financial planning efforts, to join me today to provide an initial reaction to what we know so far. So let's start with you, Gabe. Certainly the stock market has reacted very favorably to what we know so far, and long-term interest rates have actually come down a little bit. What's up?
Well, as you said, Adrian, there's still some things to be determined in the election results. But in the meantime, it does look like the market's concerns about a blue wave did not come to pass. And so the important thing is, although that's not a given, Congress does look like it will be divided again, as you mentioned, which historically has been the best condition for equity markets, irrespective of which party is in the Oval Office. And typically that's because such a situation leads to gridlock, which really gives neither party a mandate to impose their policies en masse on the markets. So we think this is what the market is onto this week.
So what were some of those policies that the markets were perhaps anticipating under a blue wave scenario that has not yet materialized?
Well, first and foremost is the tax rate, corporate tax rates going up. The market is now anticipating that likely will not happen, as any such legislation would probably be DOA in the Senate. Additionally, regulation probably will be not going up, especially on the technology stocks, which of course we know are a large part of the market. And of course, lastly is possibly an easier trade policy might come to pass. And the big issue there also is that stimulus is likely to be smaller, which would likely be less inflationary, which is a big reason why interest rates came back down a little bit this week.
Yeah, that's very helpful context. As everybody knows, we at Ballantine use a disciplined, model-driven approach to guide our investment decisions. And so it's important to bear that in mind as you hear that context from Gabe. Gabe, we have a model that tells us about our risk posture within portfolios, essentially how much to allocate between stocks and bonds. Has any of that changed, cutting through all of the noise of the moment and the emotion of the moment?
So, Adrian, it really hasn't versus where it was over the last couple of months. The bottom line is our models really have two main components, which are relative value, looking at the value of stocks versus bonds, and then the momentum in the markets. And for quite some time now, the relative value is saying that stocks are not expensive and they're not inexpensive. They're really fairly neutral. And that's when we look at the slope of the yield curve as well as the earnings yields and dividend yields compared to bond yields. And this has remained the case. And of course, we know momentum has been strong and continues to be strong this week. So the models are really saying the same thing they've been saying all along, which is that we don't have the preconditions for a bear market, which is typically that stocks are extremely expensive relative to bonds, and that momentum is strong.
Well, that's an important thing to bear in mind, especially as times are so anxious and the media tries to sell us stories about what the outlook has in mind. It has been remarkable how strong corporate earnings have been despite the global pandemic heading into the election. And as Gabe pointed out, stocks are not relatively expensively priced relative to bonds. Gabe, another part of what we do is thinking about where to emphasize and de-emphasize our exposure within stocks. And being highly selective in this environment has provided a real tailwind to our results. Why don't you take a moment or two to dig a little bit deeper beyond broader statements about the stock market and where we see trends unfolding?
Sure. So as you know, we've been emphasizing within the U.S. growth stocks over value stocks for quite some time. And while they have taken a breather over the last couple of months, the election results, it seems that growth stocks have taken off again relative to value stocks. And we continue our models, and we continue to see this happening. And this is not a knock on value stocks, as they too can go up, but we continue to see that growth will outperform value in the near term here. As it relates to the other major category of domestic stocks versus international stocks, you really have a little bifurcation in that if we divide international stocks into its components of international developed and international emerging, what we see is that for the international developed, those continue to languish relative to the US, driven mostly by a weakness in Europe, which has persisted for quite some time now. But the international emerging have really come on of late. And actually, our model has signaled that, and we are taking a position this week in emerging markets. And we think the model has picked up on a couple of things. Number one, we know that emerging markets have been inexpensive after years of underperformance, both relative to the US and relative to their own history. They're inexpensive. Importantly, the economies there are more manufacturing-based than service-based. So any further lockdowns as it relates to the pandemic may have less effect there as they export their manufacturing to other countries. And lastly, that you have a very accommodative Fed, which is essentially committed to remaining accommodative for quite some time. And that means lower interest rates and a weaker dollar going forward. And that both of those typically serve as a tailwind for emerging markets countries. So when you put all that together, we've seen emerging markets have done well over the past few months, and our models have picked up on that, and we think that that's poised to continue.
That's very interesting and helpful context for the change we've made in portfolios this week. Finally, Gabe, a question we get asked a lot on the front lines from our relationship managers who are advising our clients. As the audience knows, we have a very strict policy about keeping 2 years worth of spending needs in cash and short duration fixed income net of portfolio yield. And that was a key part of the resiliency we were able to provide during the dramatic volatility we experienced in the second quarter of this year. But Gabe, cash over and above those spending need requirements, what will you be advising clients to do with that dry powder?
Well, at this point, again, looking what the market's reaction, a lot of people were concerned that if there was a indecisive election and we were left in a bit of purgatory for a while, that the market might not like that. But as can be seen this week, that is not the case. The market actually is happy seeing where Congress is heading. And so we would advise that people should deploy dry powder as appropriate, keeping in mind the 2 years of cash that we require on the sidelines for spending needs, and not try and be overly concerned about the volatility that might come across from some of the concerns that you hear in the media, and that the message from the market is that things are looking better.
I think that's well said. As one of our Ballantine investing cardinals has it, subjectively trying to time markets is always a fool's errand. And that's the reason why we use a model-driven, unemotional, quantitative approach to guide our decisions. Thanks very much for that perspective, Gabe. So if we at Ballantine and our clients can't control the outcome of an election, and we can't control every ebb and flow of the stock market, one area that our clients can control is choices around financial planning. And so, John, I know a couple of weeks ago you authored quite a detailed article about planning opportunities in the current environment, not just the unique environment in which we see ourselves now as it relates to depressed valuations and low interest rates, but also because of the potential of a blue wave where tax policy may change. So why don't you bring us up to date with what you know now about the election result and the implications for that paper that you authored?
Thanks, Adrian. Yes. So the detail in that paper, a big component of it, was related to how one could prepare for a potential blue wave and the impact that would have on income tax planning. At this stage, as of today, we don't foresee a blue wave, and it's going to be most likely divided government. And that suggests that any of the Biden's income tax plans that we needed to prepare for by the end of the year can probably wait until we get a sense for what actually gets passed, if anything. We're really concerned that there's going to be some impacts on both income tax rates and capital gains rates. And at this stage, if there's any changes, it's most likely going to be prospective. So as of calendar year or tax year 2022.
So if what we know now about the likely election result has taken those opportunities off the table, are there other areas that clients should be thinking about given the unique environment in which we're in today from a financial planning perspective?
Absolutely. Legacy planning, estate planning still is on the forefront. We know that as of January 1st, 2026, the lifetime exemption is going to fall in half. And so any goals associated with legacy planning needs, we know that we need to act on that before that point. And the environment we're in now is particularly well suited for any types of giving that need to occur. Many businesses that our clients operate might be appraised at a lower value this year, given the economic malaise we've experienced. And so they're able to give a larger portion of their ownership and their interests to their heirs. At the same time, you've got historically low AFR rates. So the applicable federal tax rate is the rate the IRS deems is appropriate for making intra-family loans and other loans. And at the start of the year, these range from 1.61 for loans 3 years and less up to a little over almost 2.1% for loans in excess of 9 years. Those stand today at 0.14 and 1.2%. So it is very inexpensive for a family to sell assets or lend assets to their heirs in today's market.
Thank you. So that's an important conversation, regardless of the election outcome, very frankly. And it's been interesting for me, from my vantage point, to watch our relationship managers help our clients think through their legacy as prompted by this pandemic, and also take advantage of the unique environment we have today to take advantage on the estate planning side. So, John, what else would you add to your advice about how clients should be thinking about financial planning?
I think clients need to consistently reassess their goals, understand if things have changed given where they are today than where they were at the start of the year, and how does that impact where their assets ultimately flow. More importantly, they need to be in constant communication with their advisory team. Let us know if you suddenly have a desire to support greater philanthropic work in your lifetime or at death. We need to be having those conversations now rather than at the last minute when we need to act.
Well, thank you for that perspective. And Gabe and John, thank you very much for your time at short notice. We did want to provide an initial reaction to you all about what we now know about the likely election result. As I said at the outset, the final result may not be known for quite a while, but hopefully the perspective that Gabe provided on investment strategy, and also the perspective that John provided on what you can control, goal setting and financial planning, has been helpful to you all. As and when we do know the final result, we will be back to you with further detail around the implications for investment strategy and financial planning. But as always, please don't hesitate to call us, call your relationship manager, so that a member of our team can be helpful and responsive to your questions. In the meantime, thank you very much for the trust and confidence in which you place in our team.